I have a hard time believing that the fundamentals would suggest that we need to hit 1867, which would be the August lows. You know, the two issues we've had since July are China, emerging market stress, and the Fed. And just as China was getting cleared up, or at least people are coming to terms with it, now all of a sudden everybody's worried about what's going on with the Fed. So all that to say, this seems to be a major overreaction right now. I think we'll hold.
So I guess despite all of this talk about slowing global growth and the slowdown in China, do you think that the overall macro landscape is actually more stable than the market volatility suggests?
Yeah, precisely. I mean, there definitely are concerns, and these are concerns that we've had and have been in the market for quite some time. So I think it's a little bit overdone. There's no doubt that if things are slowing down and have been slowing down in the developing markets. But that said, I think it's being exacerbated a lot further than the data would suggest.
We speak so much about this tight trading range that we're seeing those US equity markets remaining in. Larry, do you think that we really need to see the Fed getting liftoff out of the way before those stocks can feel comfortable enough, I guess, for a sustainable rally?
Yeah, I do believe that. I mean, I think we need to get this out of the way, this symbolic 25 basis point rate hike, because, simply the market perceives that to be an indication that there is a tailwind in the economy, that we're not falling into some sort of recession or deflation or whatever it happens to be. So until that gets, until the rate hike comes to be, we're going to be very volatile indeed.
I just wanted to ask you about, I guess, those US markets. I mean, do you get the feeling that not only the US but the global equity market rallies that we've seen are actually maturing at some of these levels, and investors should start potentially averaging back to, say, a neutral position?
Yeah, I think I've been saying that since the beginning of the year, where we are in a maturing cycle. We seem to be stuck in this 2% growth area. And, at some point, it's just going to be harder for the market to continue to react in a positive way until we get something better than 2%, which we've been seeing. So, yeah, I think other than being broadly diversified within all different countries, small cap, large cap, I would reduce my position, as I've said all along, especially in the United States, and would put any of that overweight into Europe right now, and also Japan.
We speak about that flight to safety and very much seeing the bond market, I guess, getting a lot of attention at the moment. Overall, though, do you think investors should be overweight stocks?
I think they should be tactical, and this is no time to be a trader, but very tactical, being broadly diversified, looking for short-term corrections like we saw today, some buying opportunities, but on a dollar average basis, starting reducing yourself to being at weight to maybe underweight. So short term, yes, I would still be overweight in equities in a broad case, but slowly looking for ways to, get at weight once the market starts maturing, which should be towards the end of the year.
Larry, we've seen commodities really taking a tumble overnight, I guess, around those, growth concerns in China. Oil prices, though, remaining broadly unchanged from last week, despite those, extreme bouts of volatility. Is the Fed's decision, do you think, to hold off raising rates supportive of the growth in oil demand?
Yeah, I think it is. I think it's supportive, meaning it's going to continue in this broad and volatile trading range because people just don't think the supply or demand growth, I should say, is there. But that said, yeah, I think it is. It's really just putting a monkey wrench into all commodities, but especially the oil market right now, and seeing also what's done to the U.S. dollar. That's going to keep oil in check.
Just to finish off, Larry, I mean, we know the US economic calendar looks a little bit bare, I suppose, until we start seeing those third quarter earnings flowing through. What events, though, will you be closely watching this week?
You have to look at the PMI numbers coming out. I mean, I know that's it's more of a lagging indicator than it is a leading indicator. But with that being said, all eyes are going to be on that. Because look what happened when the Chinese market PMI came out a few weeks ago. It just, people just got very concerned with the Chinese market, sold off globally. So I think that's the thing I'd be looking for tomorrow.